All right. Hello, everyone. Hope you are doing well. See if I need to get this banner off the page here.
Yeah, hello, Nate.
How's it going?
Going good, but have to say we missed you yesterday. I think I may put up the worst shotgun Thursday performance of all time
well,
so far.
we
Day's
don't
not
have.
over, just getting started.
Yeah. I mean, it's 10:01, so we've got some time. Um, I will say, I missed yesterday, but we did win our golf tournament, so it was well worth it.
Well, that
But
puts me at ease.
yeah, I figured that would help you. Um, But I'm by the way super excited about this training. It's one that we've done versions of before, but I kind of bulked it up today, and I'm really pumped about this. And I also think it plays really well into the weekend options, which I want to talk about a little bit later as well. Also, just in general, I mean, it's just so fun to see this market do kind of what we predicted a while ago with the squeeze. I mean, just look at gold and silver since we really projected those to make their next move. Take that Sunday night, Graham. I don't know what silver's up since that Sunday night, but it's massive. I mean, it's just massively up since that timeline. And then just in the regular market, I mean, I think continuing to really grind out. Had both open automated options trades hit, so two big juicy targets there. Over on options hit again this morning to keep rolling there. I know my open two-way trade is 1 penny away from the target right now. So really just loving taking advantage of this market, and going to talk a little more about that today, and kind of one specific structure of how we do that. Graham, I just realized for opening playbook, I actually don't have any live trades in my training here. It's all education. I don't know if you had anything that you had, or will we just wait for closing playbook? Because I do have one for closing playbook.
No, I mean there was the only one I wanted to do the other day and never got around to it was SMCI, but we missed like half the move there. So on a gap fill.
All right. Well, I think it's fine. I think everyone's okay if we don't force trades. And
I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 trades open right now from opening playbook. And that does not include the 7 or 8 we took yesterday and shotgun Thursday. So,
yeah.
We've
got a lot of trades out there.
Pretty booked up at the moment.
Yeah, I'd say so. Well, I think everyone will be okay if we're not forcing trades. We're just focusing on good old education. And I think today's lesson is one that's very very worthwhile. Joseph said PSU better beat UCLA. Yeah, I think they're 0-4 UCLA, so they better beat them as the 7th ranked team in the country, or whatever we fell to after that.
Have you seen USAR?
Yeah.
Mike just posted that in the chat.
Yeah.
Consider buying 1,000 shares.
I think, Mike, didn't you actually tell us about USAR a little while ago when it was much, much cheaper? Or was that someone else? If not Mike, let us know. If not, it was someone else who mentioned it even before that. But
do you know what USAR does?
They're rare earth. We talked about them in my profit pair trading.
Explore neodymium, dysprosorium, terbium,
that's what I do too.
Gallium, beryllium, lithium, and other critical minerals.
Yeah, that's what I do as well in my spare time.
They I think they get a deal with the government or something. What happened with them?
I'm not sure, but I know that they were on our friend Anthony's list of stocks too.
That's right. They were, and it was White House talks about Trump taking a stake in USAR.
Yeah. So that was. I mean, we gave that one out, but I think Mike might have even told us before I gave it out. I think I gave it out at $9 though. So I think we're doing pretty good. Anyway, let's get rolling here. Again, exciting training, if you ask me. Of course, I'm a little biased, so I think every training is exciting. One little question for you guys, just on the housekeeping side. Was anyone having trouble getting into the room? We heard from some people that they were getting some pop-ups or some security things when they were trying to log in to the room. I want to see if anyone else, because we might have to do some trouble shooting there just to make sure that we can get everyone in here as possible.
Nothing on my end, Nate, but I know I did see a message or two about it and heard from our customer team.
Looks like everyone in here was okay. Yeah, CLSK, by the way, still ripping and roaring. I've still got my trade on there, and I'm sure you do as well. So that one's been a powerhouse.
Oh, here we go. Yes on Firefox from Roger. Russ says yesterday, but today is good. Jesse, yes, yesterday. Yes from David.
Okay, seems mostly okay. All right, well, stay active in that chat because I'm going to have a few questions for you guys along the way today, as I normally try to do. Just incorporate the chat and some feedback, and like I hinted at in Telegram, might even give away an opening playbook shirt or something if someone can get one question in particular right that I'm very curious about, because I think there is kind of a missing element here that most people get wrong, and I think is a big game changer. So, thank you, Andy. Appreciate that, and great job on those of you who are following O&O. It's been getting some scrappy wins the last couple of days. So today, I want to dive into what I think is probably the number one thing. If you looked at everything I've done in trading, especially the last couple of years, probably the number one thing that has really changed the game for me in my own personal trading. And now I would say that has also changed the game for thousands of students. And I actually consider this the biggest advantage for retail traders. And I would say it can be summed up, the advantage in two different ways. One, creating more scenarios where you win. That's a thing that you'll hear me say a lot, just setting up your trades where there's more scenarios you can win. But two, kind of in that same thought process, is actually turning losing trades into winning trades. So what I would say that most retail traders do is they end up turning winning trades into losing trades by bad structure, bad management, whatever. And I think what you can do to be a better trader is you can actually turn losing trades into winning trades. And this concept helps you do that very organically. Now, most traders open a trade with very few ways to win and many ways to lose. That's just the facts. For example, you take a chart like this. Most people are going to buy a call option where the stock has to go up to make a profit on the trade, or they buy a put option where the stock is going to have to go down. And I would guess if everyone answered in the chat, most of them before attending opening and closing playbook probably would have said that 90% of the trades they did were just like this. They buy a call or buy a put and hope for a directional trade. But of course, as you guys probably know by now, the challenge with regular options is that you're battling timing and direction and implied volatility all at the same time, which means you don't just need the stock to go up, you need it to go up a lot at the right time. And then, by the way, you need to make a perfect exit on top of that, which is why some recent studies suggest that 90% of regular options buyers actually lose money, which is just a wild statistic because you would think it's more of a coin flip scenario. The stock's going to go up or it's going to go down. So that statistic always blows me away. Now, most of you know that Graham and I like to flip this on its head by using a line in the sand. And this alone is extremely powerful because it completely changes the way that these scenarios work. It flips winning scenarios around. And I always like to think about it like this. A regular call option has to overcome a certain area just to have a chance at a profit. We call that the implied volatility or the expected move. So while you might be entering the trade down here where the price is at the time, your line in the sand on a regular option is somewhere like this. And by the way, it's changing all the time because of time and everything else. And so you're not actually trading for the market to go up. You're trading it for it to go up and beat this expected move. And you have to get the timing and exit right to have any chance of making a decent profit. But if you compare that to a line in the sand below the current price, which flips the area that you have to overcome into a cushion, as you often hear me say, when I say, hey, I'm trading with a cushion, that means not only do I not need it to go up, it can actually even go down a little bit and I'll still win the trade. So price can go up, price can go sideways, can go down a little. It can even go down a lot and then bounce back and finish above the line in the sand. And I will still win the trade in all of those scenarios. And what's amazing about spreads is that you get the entire value of the trade in every one of those scenarios. So hopefully, if you've been in sessions with Graham and I for a while, we've already convinced you that this structure is a game changer. I mean, hopefully the first 30 slides that I just covered, that's all, known to you, no surprise. Give me a yes in the chat if that's just, beating a dead horse. You guys already are very comfortable with everything that I've said so far. And you're already convinced that regular calls and puts are a big disadvantage, and trading with a line in the sand or a spread structure is a big advantage. I think most of you have already hit that point of no return in the trading journey. But here's the big but. I don't actually trade that way most of the time. The explanation that I just gave you, where we're waiting for this trade to finish above the line in the sand, is not actually how I trade most of the time. You see, I started out by realizing that creating my own line in the sand massively flipped the probabilities in my favor. But everyone else I knew who had discovered that way of trading left it at that, placing trades that need to finish above or below the line in the sand. What I noticed, and then later tested extensively, was that the price movement on a spread is actually quite sensitive. And this might sound simple, but it's actually pretty jaw-dropping reality when you put it into practice. Meaning, let's take an example like this. If you took this trade, you buy the $200 call, you sell the 205 call, and you pay $3 to enter with a line in the sand above 205, what everyone I'd ever seen do was wait until it got to expiration here and collect the full $5, which means a $2 profit, right? They paid the $3. If it expires above there, it's worth $5, and you generate a $2 profit. That's what everyone I had ever seen do that. But I noticed when price popped, the value would actually jump pretty quickly. Like it might be worth $4 just one candle later. You paid $3, now it's worth $4 here. Or it might be worth $4.75, even though it's got 5 days left in the trade at this point in the trade. So it could only be worth a max of $5, but it's already worth $4.75 at this point in the time. And the more I thought about it and the more I saw it in real time, I realized that spreads made just as much sense to use targets as any other kind of trade, maybe actually even more sense, which I'll get into later, and I think I can prove to you why they actually make even more sense. And since then, I've been trading and testing with targets, non-stops. And now I legitimately believe that using a good till canceled limit, in other words, a target on your spread, is probably the single biggest hack that retail traders have. And I really believe that. So today, I'm going to dive into more specifically how they work. But first, let's actually jump back to the why this was such a big breakthrough. Because if you've been trading with me for the last year, or you've now seen what Lance and other people have done, that they've kind of, copy and pasted some of our breakthroughs, which I'm very happy that they've done that. You might not realize how big of a breakthrough this actually is, because it sounds simple. Put a target on your spread trade. But if you guys just go back 2 years, I would challenge you. I bet you will find almost no one trading this way. I could be wrong. Maybe you'll find someone in the deep corners of the internet who is doing this. But as far as I looked far and wide, I could not find anyone who had figured out what such a big advantage of using a target on a spread like this was. So here's the question. Why was seemingly no one out there using targets on trade structures like this? Does anyone know, by the way, before I flip the slide, does anyone actually know in the chat? Because there is a prevailing wisdom of why you simply don't do this. And I think why up until I kind of had that breakthrough and we started doing it, and then more people who trade with us, Lance and Roger and other people have done it. Jack now even would do it, which he was very old school up until a couple of years ago and would never use a target on a trade like this. Well, it's because the whole idea of the line in the sand is a time decay strategy. That's the why. That's why they don't use a target. The more time the trade sits above the line in the sand, the more time decay value the trader gets. So think about it. Why would you ever take a trade here, right, and then get out here, when the whole point of the trade is to take advantage of the time decay here, right? Okay, let me walk you through it again. So this is a time decay based strategy. We're getting in above the line in the sand in most cases. We're letting time decay work on our behalf. So why would you take a trade here and get out early? And the whole point is you're missing this time decay. That is why no one was doing it, because the whole point of a time decay strategy is to hold it through the steepening of the time decay. It makes sense, right? It absolutely does make sense. That's why someone like Jack Carter would never get out of a trade, over here. He would wait, because the whole point is to use time decay, right? And I, like millions of people, always assumed that was how you were supposed to trade these kind of time decay based structures. Think of the income machine or overhead options or any of the strategies I use where you're starting already below price. What you're doing is using a time decay based strategy. As long as it stays above that line in the sand, you're getting more value on the trade. And I firmly believe it's why no one I'd ever talk to is using targets on those sorts of trades, because of what I just showed you. All the prevailing wisdom is that you use time decay to your advantage and accelerates over time. But does anyone know the problem with basing it all on this curve? And I'll actually stop here for a minute. Let me know in the chat if anyone knows the problem, because there's a significant problem here. Even though it's correct and it makes sense, there's a big issue that for whatever reason, I don't think it ever made its way into mainstream, where basing your trades on this curve has an issue. So if someone gets this right in the chat, I don't know if Dave's back on yet, but we'll have to do a opening playbook sweatshirt, because so far, I don't think people realize the issue. So let me give you another 10, 15 seconds here to let me know in the chat and tell me what the big issue here is basing it on this curve. Okay, some of you are close. Okay. Wondervile got it right. Okay. We need to get Wondervile here. Exactly right. See, some of you are close. You're saying, well, if it goes against you, but that's not really it. The real issue is that it doesn't take into account price. Okay? The reality is, as price moves in your favor, you can get a ton of value very quickly. So the reason this is so deceiving is because it assumes that price stays exactly the same. That's the issue. Time decay is helping us, right? It's helping us, and it will always help us if we're in a good position and the price is above, but it doesn't take into account price moving, and price does move, right? So you have to account for price. The reality is that as price moves in your favor, you can get a ton of value really quickly. If price is neutral, then you'll get value slowly. Let me say that again. You guys might want to write this down for a spread trade. This is assuming you're trading like I trade. If price moves in your favor, you can get a ton of value very quickly. If price is neutral, you can get value slowly. One more time. If price moves in your favor, you can get value quickly. If it doesn't move in your favor, you can get value slowly. Okay, does that make sense? Sorry, I know I'm asking for a lot in the chat. It's just helpful if you interact, so I know that I'm making sense here. When price is going with you, if it's moving, you don't need to wait for that curve because you're going to get value quickly. If price isn't moving, if it's more neutral, you'll still get the value, but you'll get the value slowly. A perfect example, by the way, would be automated options. Price moved a lot this week, so we got out a full week early on our trade. Why? Because price moved in our favor. So by using a target, and thank you for the yeses in the chat. It sounds silly to ask you guys to put a yes in the chat all the time, but it really does help me know if I'm making sense and if we're tracking together. And the whole point of me being on this morning and every morning is to teach you something. And so if it's not making sense, that's important, and I need to pause. So by using a target in most situations, you can actually take advantage of both scenarios. And this is kind of really where I think it becomes mind-blowing, to be perfectly honest with you, is that you're actually taking advantage of both scenarios with a target. Meaning that instead of waiting for a trade to finish above the line in the sand, we set up a target so that any point a trade shows enough profit, our broker automatically clocks us out. We're not doing anything. We're not watching the chart. We just let the broker clock us out as soon as that target is hit. So here's the situation. Imagine a trade you take here. You have a line in the sand here, right? Like I usually do, below the price. That means you're already starting out in a winning position. Anything above 205, you win, period, end of story. You have an expiration date here. Like we said, if price finishes above that red line at expiration, we win. So the price could go mostly up. It can go mostly sideways. It can drift down. It could even collapse and then bounce back up, and we're still going to win the trade. All of those scenarios are a full win, which again, I think is already pretty amazing in and of itself. But to give us even more profitable scenarios, we can place a good till cancel target on the trade. Because just think about it. While this is a great win, it's still predicting where a stock is going to finish on an arbitrary day. Yes, it's great, but it's still assuming that we're going to get the price to finish above that line. If the stock happened to look like this instead, where it looked great for a while, and then it actually went below, well, then we lose on the trade instead of winning on the trade. And this becomes more important if you are using a more aggressive trade where you don't have a big cushion. Like with automated options, where our line in the sand is actually above the price. We actually need the movement up. Now we're playing with a little more fire because we're going for a little more profit, which means we don't have quite as many scenarios to win the trade. Now remember, anytime you take a trade like this, you have a line in the sand and you have a window, right? Meaning you have a window of time for that stock to make its move, or simply a window of time for it to stay above your cushion. Either way, you have a window. Whether you're starting below price or above price, you have a window of time. Whether it's 1 day or 30 days or 1 hour or 300 days, doesn't matter. You have a line in the sand and you have a window. So here's your window. Do you guys think, this is a question I ask all the time, but I think it's worth asking again, do you think your odds are higher of picking where the stock will end on this particular date, July 31st or October 10th or whatever, that, hey, it's going to be above 205 on this date, or that somewhere in the window it's going to move up? Do you think your odds are higher that you're going to pick a specific day and a specific price and say that the price is going to be above that level at that time, or to say, listen, I've got 14 daily candles here. At any point, I think the price could go up during that window. Now, I would say it's pretty obvious that we're more likely to get a pop somewhere in the life of the trade than predict where exactly the stock is going to finish. And by the way, I don't just think that. I will prove it to you here in a moment. And I think this is one of the mind-blowing things. I like to do things by data, not just assuming that I'm right. I do have a habit of assuming that I'm right. My wife can tell you. I have a little bit of a habit of assuming that my logic makes sense and that I'm right. But I really like to back it up with data and prove it out. And I'll do that for you in a second. The fact is, most stocks don't move in a straight line, right? So if you enter a trade here and your line in the sand is here, well, if your trade expires on one of these days, you win. But if it expires on one of these days, you're out of luck. But if it expires here, you win. And so on and so on and so forth, right? My point being that predicting where a stock is going to finish can be extremely tough. And the good till canceled limit, the target, changes up that scenario completely. Instead of needing to pick where a candle is going to finish, we lay a blanket of profitable outcomes over the chart, right? So think about it. A chart like this, you have all kinds of winning scenarios and all kinds of losing scenarios. What I am doing is I'm saying, just give me the winning scenarios, baby. As soon as it pops, get me out, get out of Dodge, and let's go. Because if you waited, or by the way, if you use a stop loss, yikes, you are in a situation where you are setting yourself up with all kinds of losing scenarios. I want to take as many of those losing scenarios away and stack on as many winning scenarios. So that anytime the price hits that range during the window of the trade, whether that window is 1 day or 1 year, does not matter. The same principle applies. Now, let me give you a wild, real example of this from last month. I shared this one other time, but it's just so cool that it's worth sharing again. This happened last month. 2 months ago now. So on July 15th, I sent out my overend option trade here. My line in the sand was here. My expiration was here. So it was a 1 day trade. So I needed the market to be above this level at the end of the day, right? I took the trade. My line in the sand was here. I needed the market to finish above this on this corner. This is my line. This is my expiration date. Well, the market didn't do what I wanted it to. It started heading down. If you guys are asking about 60 minutes, I don't know. It's Graham's service, so I don't know. It's 10:30. I don't know if that means that you definitely won't get a trade or not. But in this example, speaking of 60-minute, we'll actually talk about that in a second. The trade was going against me here. And that's where things got interesting because Graham's 60-minute income trade fired right here and his fired to the downside because we had negative momentum. And he had the very same expiration, right? Because his is 0 DTE for the day minus 1 DTE for the day before, which means they're the same expiration, which means he needed the price to finish below this level at the exact same time. Now, I'm no rocket scientist, but I know that price can't finish at both places at the same time, right? It physically cannot finish above that line in the sand at the end of the day and below his line of the sand at the same time. But the crazy thing about this scenario is that Graham and I both won our trade. When some news came out, Graham hit his target here to the downside because he had a good till canceled target on the downside trade. Boom, hit his target. And then when the market rebounded back up later, I hit my target having no idea where the market would end up. So we traded in opposite directions with diametrically opposed lines in the sand with the same expiration, and we both won the trade. Does anyone else think that is pretty remarkable that that's even possible in the stock market? Every time I go through that example, I think that should be illegal. You shouldn't even be able to do that in the stock market. It's a crazy example. So hopefully you're seeing now what I mean by creating more scenarios to pull out wins. In Graham's case, he turned what would have been a losing trade, period, end of story, would have lost if he waited till expiration. And instead of losing, he got a juicy profit. Now, let me show you what that looks like at scale, because if you really want to get crazy, this is pretty wild. Anyone want to see what this looks like over the course of thousands of trades at scale? Check this out. Okay, here is a strategy that you trade every day. Notice it has 1,474 trades, 71% win rate. It turns $25,000 into $40,000. It's actually not a bad strategy. 25 into 40,000. But if you trade 10 years, you'd want to have a little better performance than that, I imagine. What this strategy is, it is looking for the market to finish a little above 0.3% over 60 days. Okay, does everyone see that this needs to move up 0.3% over 60 days? That's the strategy. Everyone see that? Because that's our line in the sand. We're selling a call at 0.3% above the money. Out of the money, it means it needs to go up 0.3%, but we're giving it an entire 60 days to finish. And this strategy is no target. It's just simply saying it's either going to finish above that line or it's not going to finish above that line. Period. End of story. And if you do that, it takes you from 25,000 to 40,000. Now, what we're going to do is we are going to add a target. And my question for you in the chat is, how much do you think it will change? The current strategy takes it from 25,000 to 40,000. If I add a 30% target where we're not waiting the 60 days to finish above the line in the sand, we're simply taking our profits as soon as a target is hit, what do you think the new ending capital will be? I'll already tell you it's going to be way better because targets are amazing. How much better do you think it's actually going to be? In 10 years, this one goes from 25 to 40,000. Let me know in the chat. We're keeping every single thing about the strategy exactly the same. You can see the only thing I'm going to do is type in a target here. That's it. Every other element is going to stay exactly the same. This will take a couple minutes to run because it's running like 1,500 trades. Oh, wow, we've got answers all over the board. Everything from millions to double to 500,000. Well, I can tell you my guess originally was that it would 3 to 5x it, because I'd seen that in some other tests, that it would take a winning strategy and putting a target on it could make it 3 to 5 times more profitable. That would have been my original guess before now I know the numbers. Because I would have said, okay, well, if it went from 25 to 40K, it probably would go from 25K to 150K, maybe. But remember, all I am doing is adding a target. The entry is the same. The timing is the same. The expiration is the same. The strikes are the same. Every single thing about this strategy is identical except for me adding a target onto the trade. Now, let's wait. Let's see if it's 3 times or 5 times. Remember, our ending capital was 40K, so that's what we're comparing to here. The target is 30%, Charles. We're on the edge of our seat here. Let's see. We probably got about 30 more seconds. Here we go. And there it is. From 25,000 to 40,000. Now, from 25,000 to $20,970,000. That is the difference, my friends, on the identical strategy, identical entry, identical strike prices, identical DTE, every identical capital allocation. We didn't raise the stake. Identical capital allocation, everything the same, except for using a target. From 25 to 40K, now from 25 to $21 million. And if that doesn't prove to you the advantage of just giving a trade more scenarios to win and letting it hit those targets, folks, I don't know what will. So that's like 300 times. Well, 40,000 times 100 would be 40 million. So I guess it's 50 times, right? Is my math right there? It's or no, 40,000 times 100 would be 4 million. So it's 500x. So there are some reasons why this happens that we can get deeper into in another lesson, because it's a little bit beyond even deeper. By the way, notice the drawdown's less. It went from 25,000 to 21 million, and the drawdown went down. It's insane. It's insane. It's totally insane. And folks, that is why I am such a believer in this concept. That if you use a target, you are creating so many more scenarios to win. Now, like I said, there's ways that we can go even deeper into this. But we won't do that exactly right now, because I want to show you one more thing, which I also think is totally wild. Here's it is. Anyone feel like their mind gets blown every time they just look at the actual data on this and think about the logic? That was 10 years. That was 2015 to 2025. Someone asked about the timeline. Well, I think this is just as mind-blowing. I mean, that test always, it just makes me scratch my head. But then I go through the numbers and I check it. And it's real. It's just crazy. But I also showed you this example of having a target on a trade to create a blanket of winning scenarios, right? So this was the chart I showed you. It looks like this. But using a target is actually a lot better than that. Don't forget, folks, time decay is real. We just often don't need it. Okay, let me say that again. Time decay is real. It does work. If we start out in a winning position and price stays the same, the time decay will help us. We just often don't need it. Okay? Again, some of these things sound simple, but they're kind of important. They're kind of mind-boggling. Which is why the real target area is not actually a square blanket. It's more like this. Because time decay is helping us. If price is here and our line in the sand is here, as we get closer, this area makes it easier and easier and easier and easier to hit that target. How many of you guys have experienced that with overnight options? Price was here and we didn't hit the target yet. And then we started losing. You're like, oh, no, it looks ugly. But then it just bounces a little bit above it later on. And boom, we hit our target and get our money. Why is that happening? Because time decay is helping us. It's just often we don't even need the time decay because if we get a spike early, we take our profit, but we need less and less and less of a spike to help us. And knowing what you know now, what I just showed you, knowing what you know now, you can probably understand how the weekend options are undefeated in 2025, right? Because the trade looks just like this. I'm giving away the secret sauce. If you guys want to take notes, I'm giving away the secret sauce here. The trade looks like this. We enter at the end of the day on Fridays, just like we will today, right? And then Friday to Monday, we don't have a profit area that's up here the whole time. It actually moves aggressively toward us at expiration. Okay, but notice, this is the secret sauce. The timeline prices in the weekend. Guys, this is what's beautiful. It moves toward us over the weekend. It values those weekend trade days. And here's the really crazy part. Weekends on average actually do not move all that much, contrary to common opinion. How many of you guys have heard weekend gaps are huge? Weekends move way more. They're more volatile. Well, that actually is true, but it's only true because of the outliers. On a regular basis, they actually don't move. It's like the median versus the mean. Any of you guys statistics majors? Maybe Jason B's in here. He can help us. The median versus the mean, right? If you take the outliers into account, yes, weekends are more volatile. But if you take it on a numeric basis, 9 out of 10 times, they actually don't move that much. And so we're getting all the value of the time decay on the weekend, even though the market is closed, which is kind of crazy when you think about it, right? And this is the hack with weekend options. If you want to sum it up, now I use a couple other filters and some things to help us, obviously. But if you want to just think about the basic hack here, this is really it. When Monday opens, our next candle is already right here, right? Well, what does that mean? Well, it means we're already super close to that target. We benefit from all that time, even when the markets are closed, which is why of every strategy I have ever traded, weekend options hits the target the easiest. Okay, does that make sense to everyone? I love all my strategies, don't get me wrong. But of every strategy I have ever traded, weekend options hits the target the easiest. Knowing what you know now, knowing what we covered in our class today, is that light bulb going on for you guys? Why weekend options hits the target so easily? Because if we get any price movement, it's going to be in good position. But also, we are already starting off with that target moving toward us because the time decay is working in our favor so aggressively. Okay? And using a target is a lot better than that because we don't even have to wait. We just let this area come to us. Okay? So hopefully that makes sense. Now, last week, I meant to give you guys a chance to join weekend options last week and totally forgot. So I will give you a chance to join today because I always try to do it before our next trade. Before we jump into weekend options, let me give you a couple minutes because I also do like to answer any questions on Fridays. Try to give some time at the end of our Friday sessions to answer any other questions. But if you guys want to stay on board here, we will play that weekend options presentation for you in just a minute. But let me just kind of pause now before we do that and answer any questions that we have, and then I'll make sure that I give you guys the chance to watch that weekend presentation. Yes, exactly right. So this is the weekend, and Amex said, well, what if it gaps down here? Well, yes, then you need it to go up, right? Then you do need price to come back across the line of the sand. The thing is, the weekends don't do that nearly as much as you would think, and we have some filters built in to help us. If you guys look, you'll see we have had some gap downs in 2025, and yet, anyone know our win rate for weekend options in 2025, even with some gap downs? You've probably heard me say it a few times, so you probably do know. 100% win rate. We have not lost a single weekend option trade, even though, of course, the market has gapped down. Now, to be fair, I'm going to lose eventually. I'm not saying that weekend options is perfect and it'll never lose. What I'm saying is that it is the easiest one to hit the target. It's the easiest one for all of the reasons that we learned today. And so hopefully that makes sense. Shrita says, I hope not. Unfortunately, I am sure that over time we will eventually hit a loser. Okay. So someone asked, how do you know where to place the target? Great question. I would say that it's very strategy dependent. So it depends on how aggressive you want to be with the strategy and how aggressive the strategy is fundamentally. What I mean by fundamentally is it already out of the money? Is it a strategy where you already need the price to move, or is it something more like the income machine where it's very defensive and you have a big cushion? That in and of itself is going to dictate how aggressive you want to be with the target. So for example, if I am trading an income machine trade where I'm paying $4 on a $5 spread and my target, my max potential is 25%, well, then I'm not going to go for, a $4.05 target and try to make, 1 or 2%. I'm going to go for a $4.80 target and still try to make 20%. So I'm going to use a percentage of the meat on the bone that's left over, right? How much profit is left over. Dean, do you mean functionally? How are you doing it? Like you were setting up a closing order with a good till canceled limit as soon as the trade is filled, or do you mean like how are you choosing the percentage? I'm not sure if I'm understanding your question right. Yes, I always use the same target for my mechanical strategies. Someone asked that question. So for overnight option, we're always using the same range. It's not exactly the same number, but we have a range that's built into the mechanics of the strategy. So we are not looking at like, hey, I feel good about the trade, so I am going to go higher. I feel bad about the trade, so I'm going to go lower. It's all mechanical on those strategies. Great questions. How do you determine the meat on the bone? So the meat on the bone is the width of the spread pro minus what you paid. Okay, so let me walk you through that here real quick. Let me just get my pen open, and I'll answer that question more thoroughly for anyone who has that question. Let me just do this. Slideshow. Share my screen. Then I can just kind of draw it out for you here. Okay, how do you determine your meat on the bone? Okay, well, let's say that I buy a $200 call and I sell a $205 call. Well, now I immediately know the max value or the max potential of the trade. It's worth $5 at its max because 205 and 200 are $5 apart. So I immediately know that it can only ever be worth $5. Okay? So if I pay $3, how much do I have left on the bone? Someone let me know in the chat. If it can only be worth $5 and I start out by paying $3, how much meat do I have left on the bone? I have $2, yes. Because it's worth $5 at its max. I paid $3, I have $2 left. Now, if I pay a different amount, it changes the math, right? Let's say it's out of the money and it's aggressive, and I only pay $1 for it. We're going for a home run trade. Well, the same spread now, instead of having $2 of profit potential, is going to have $4 because it's the same $5 width, but it's based on what I pay. And you could do the same thing here if you did a $1 spread, right? So buy the 99, sell the 100. Now, same thing. If I pay 50 cents, well, this can only be worth $1. And so I'm going to have 50 and then 50 left over. But if I take the same trade and I only pay 25, well, now I have 75 left over on the exact same trade because what you pay is going to determine how much value, because the width of the spread, the max value, will never, ever, ever change. If it's a $1 spread, it can only ever be worth $1. So what I'm saying is, if I pay 50 cents for the trade, I can put a 75-cent target on it and make a 50% ROI, right? If it's $1 and I pay 50 cents, I can put a 75-cent target on it. But if I pay 70 cents, well, then I'm not going to put a 75-cent target in most cases because I want more value, and I'm going to use a percentage of what is left over on the trade to determine that. All right? Well, no, I don't look for trades with more meat on the bone necessarily. Good question. But I do dictate how I'm going to manage the trade based on how much profit potential is left over. So I'm happy to take a trade that's a $5 spread that I pay $4 for if it's a high probability. But then that $1 left over is going to dictate how much I am going to actually manage. And different strategies have different guidelines for that. Someone asked what the target was on the test I gave you. It was a 30% target. Okay, so it was based on 30% of the debit that you paid. GLD and IWM, what is included for target? Susan, I'm not sure I understand your question. What is included for target? Not sure I understand exactly what you are asking there. All right, so I'm just scrolling through. Let me know if I missed your question. Just scrolling through here. Andy said, I'm in the weekend trading. Excellent, making me money. Awesome, Andy. Happy to hear that. Love getting the feedback on weekend options. It's always fun because it's, it's just it only triggers, maybe 35 times a year, but the profit factor in the ROI has been so good that it's like, every time you get that signal, you're rearing to go on that strategy. Process, so we can all be millionaires. Well, I don't know if I can promise that, but I do think what we learned today, if you start stacking those edges into your trading, I do believe they'll make a massive difference. I would say that's probably the most common feedback that I get is, wow, just the structure alone and understanding how this works and using targets have dramatically changed, the way that I trade. Chris, that one is 30% of what you paid for the trade, the way that Option Omega does the math. I'll verify that, but I'm 90% sure, Chris, that the way they do their math is basically if you pay 50 cents, well, then your target would be 15 cents because it's 30% of what you paid. I'll verify that in a minute. Dean, no, that would just be for that strategy. That strategy, 30% is kind of your sweet spot. In other strategies, it will be different. So for overnight options, for example, it's closer to 20%. But for automated options, it's 50%. So it depends on, again, time, risk to reward, where you're at in the line of the sand, all that kind of stuff. Yes, I have run that test with lots of targets. Now, I don't like to over curve fit, so I'm not running it with like a 27% target versus a 28% target because that's just over curve fitting history. But I'll do it in like 5% blocks, 15, 20, 25, 30, 35, 40, 45. Then I'll get some ranges, then I'll kind of optimize some other factors. I'm not going to look at like, okay, a 27.2% profit rate is better than a 27.8% because then you're just over curve fitting history and giving yourself a strategy that's not necessarily going to be forward looking enough there. Okay. Does the income machine factor in stocks that are in strong sectors? There's not actually a sector filter in income machine. Nathan, good question. My original strategy actually was more sector based. Some of you guys might even remember that I was trading almost exclusively the sectors themselves, which I still want to do with a whole different strategy because I figured out some new ideas there, by the way. But right now, it is only stock-based. Tom, it depends on the strategy. So to determine the target, do I have a formula? Yes, but it depends on the strategy. So overnight option has one formula. Automated option has a different formula. Weekend option has another formula. So most of my strategies are formula-based, but they will depend on the actual strategy. So again, if you think about it like this, let's say I'm taking a trade here and my line in the sand is up here, right? So this is going to be an aggressive strategy where I need the price to actually move. I need it to start here and actually cross over. Well, if your spread is, $1, you're probably paying like 30 cents or 40 cents down here, which means you have 60 cents of profit up here. Well, that's 150% potential ROI. So if you put in an 80-cent target where price can get to something like this, your 80-cent target is going to equal a 100% ROI because you paid 40. If it hits 80, that's 100% ROI. But if you just do the same trade with a different scenario where you trade up here and your line in the sand is down here, well, guess what? It's still going to be the same dollar spread. The width isn't going to change if you're trading the same stock. What's going to change is that I now paid 80 to start. So I paid 80. If it finishes down here, that's the 20-cent loss. So I no longer can put a target of 80 cents. I'm not going to make any money. But if I put a target of 90 cents, then I'm going to make, a 12% ROI. But my odds of getting that 12% ROI are so much higher because now I have a big cushion on the trade. So the scenarios themselves are going to dramatically affect what you're going to do with your targets, where you're going to place them, how much ROI you have on the table, all that sort of stuff. Okay. Yes, you can do that, Depot, or that would definitely be a way to do it. Now, how to set the target on the trade is very simple. Now, for different brokers, it'll have different, it'll have different buttons and things like that. But in every scenario, you are creating a closing order on the trade as soon as you finish. The main thing you want to do is make sure that you're setting it up as a good till cancel. That means that order is going to sit in your brokerage during the entire window of the trade. And if it ever moves in your direction at all, boom, not at all. If it ever moves in your direction enough to get the value of that trade, the broker is going to automatically cash you out with a winning trade. All right, folks, I am going to get set up here to play the weekend option strategy. So what this strategy is, exactly what I showed you there at the end. It is, in my opinion, the easiest and most effective way to hit that target. Okay? That's what weekend options is. Hold on, give me 1 second. Let me make sure Dave is going to be able to come on here. It is the simplest way because we are combining all of those edges. We're combining the line in the sand. We're combining the time decay. We're combining the use of the target and how it actually moves towards you. And then we're combining on top of that the weekend effect, where over the weekend, that time decay is getting you closer and closer and closer to your target, even though the market is closed, which I think is just one of the most incredible things ever. And so I do that, to answer your question, Chris, I do that on most of my strategies. There are a few instances where I will say it's a little bit different because of other things that impact it. But for most of my strategies, that edge is very dramatic. Just like I showed you on that test example, the edge becomes fairly dramatic there when you're using the target that's moving towards you because you're combining all of those elements like I was just saying. So if you guys are not in weekend options, we'll have our next trade here, well, I guess in about 3 hours. So we'll have that trade set up. It'll go at the end of the day on Friday, like it always does. And the entire point of that strategy, which the data and the live trading, I think, verify extremely well, is that when you stack up all of those edges and they're all kind of working together, it just makes that target easier and easier and easier to hit. And we've hit it 100% of the time so far in 2025 for that reason. So again, hope this lesson just in general was really helpful for you guys. Give me a yes in the chat if you had a couple light bulb moments. I hope you did. And then if you really want the light bulb moment to actually come into practice, well, then, of course, I would suggest trading weekend options because it's kind of a culmination of all of those light bulb moments stacking up together to help you hit more and more and more targets. John said from a UCLA alum, well, John, I would not be wishing UCLA much luck tomorrow, but other than that, great school. And, I hope they beat USC at least every time they play. All right, Dave, we good to go with weekend options?